But look, so whenever we do these presentations, Emma always says, look, you know, you and the team sit in the coalface in London, come out, tell us about the big picture. And I guess I always do my best. The caveat I'd make is I don't have a crystal ball. Nobody has a crystal ball to kind of predict the future. I guess we do have some interesting insights being at the coalface every day with markets, and all I'm trying to do is share those with you. We don't take big macro bets in the GVF portfolio. So hopefully investors that know us now understand that it's a relatively conservative investment portfolio. We try and punch above our weight in terms of returns for the amount of risk that we're running with. But we obviously have to be aware of the big picture, and we do have to manage it in the portfolio some time. And I guess just to start us off, I mean, it's a fascinating time to be around. Like, whether we fully understand it or not, we're currently living through one of the biggest investment booms in history. This year, America's tech firms are going to spend $400 billion developing artificial intelligence models. That's $400 billion US dollars. And that's really the thin end of the wedge. That number has been accelerating over the last few years and is expected to accelerate over the next few to come. The numbers that I've seen most recently say that US tech firms are going to spend $3 trillion US dollars over the next 3 years building out AI models. And that's to kind of put that into context between what's being spent this year and what's coming down the horizon over the next couple of years. That's 2 times Australia's annual GDP being spent on developing AI. And while the Americans are at the front of the curve, you know, the leading edge of artificial intelligence, they're not the only game in town. China's spending vast amounts on AI, as are lots of other European countries and other countries out there. So there's clearly a massive spending boom going on, one that I think a lot of us sort of day to day don't quite appreciate. Now, what is AI? I know a lot of us are still struggling with what it's all about. I know, you know, in my own life, it's probably its biggest use today as it helps with the kids' homework. But
it's worrying when our kids are 8, 6, and 2.
I know. Then we need
help. You need help.
But for the AI boosters, I think the thing that everyone's chasing at the moment, why so much money is being spent, is this concept of AGI, artificial general intelligence. So there's a big arms race going on at the moment to see who's going to be the first firm to develop models that are basically as good or better than humans at thinking jobs. And the first firm that does achieve that is going to walk away with an incredible kind of investment prize. If you think about how dominant Google is in internet search and how profitable that business is, or you think about Facebook, how dominant it is in social media and how that's just a massive cash cow. What's essentially going on at the moment is there's a massive arms race between all these big tech firms. When they see the prize, the one that establishes itself as the AGI player. So that's all interesting. Vast amount of capital being spent. What does that mean for markets? What does that mean for what's going on? Well, just to kind of bring ourselves back, 6 months ago when I was out talking to people around Australia, the big preoccupying force in the market then was Donald Trump. So his return to the White House had been rather unorthodox. His tariff policies that announced particularly, and along with a lot of other kind of economic policies he was putting out, were incredibly unorthodox. And whether they're right or wrong or not, that's not a political statement. Most economic forecasters expected the US economy to start doing it very tough. The big protectionist lurch the US is going through under conventional economic models should be very damaging for growth. So not long after April, most forecasters, professional forecasters, were lowering their growth targets for GDP growth this year and next year. If you remember, you would have seen a lot of people saying the US might actually slip into recession. Fast forward to today, October, nearly November, that clearly hasn't happened. The US continues to grow at an incredible rate. What's going on? Well, we can see the numbers now. So for the first half of this year, US GDP was 1.6% annualized. And that's a little below the kind of 2% figure you would have expected before Trump started announcing some of these policies, but well ahead of most of the other rich world countries in the world, and certainly well ahead of, you know, recession level. What's happened? Well, what's happened is it's become increasingly clear that as the year has progressed, this massive AI capex boom is overshadowing what Trump's been doing. He's really been given a complete free kick. And I don't think the nuance at this point will ever get discussed widely at the White House. But if you drill into the first half of this year's growth numbers now, what I find really fascinating is that if you take out this one-time effect from capex from big tech firms, and it is a once-in-a-generation kind of splurge, if you take that one-time item out of US growth figures, the US economy didn't grow at all in the first 6 months of this year. And what I find really fascinating about that is we're obviously aware that markets are incredibly frothy. There's a huge amount of exuberance going on out there. And if you juxtapose where we might have been if the US had been flirting with recession for the last 6 months, I think it's a really interesting kind of thought experiment. And more importantly, I think it sort of tells us where we are today. Not only are these big tech stocks driving financial markets higher, dragging all the indices they're part of higher, they're increasingly carrying the real economy with them. Most of the economic growth we're seeing in the system at the moment is coming from capital expenditure from tech stocks. Now that begs the obvious question, which I'm sure you would have seen talked about in the papers. Are we heading towards a bubble? So has the hype around AI gotten ahead of reality? You can see on this chart here the makeup of the S&P 500 index, or rather the proportion of the S&P 500 index that's accounted for by technology stocks and communication stocks. And as the Magnificent Seven or all those FANG stocks have done so well in recent years, you can see that now they've done so well that they've become an increasingly big part of the index in total, and they now make up 40% of the entire S&P 500 index. Same peak that we were at the top of the dot-com bubble. Now those kind of charts and those kind of articles you read about in the paper certainly adds a lot of weight to this idea that maybe we're in bubble territory. I'm going to try and present a more balanced, a more nuanced kind of proposition. And I think, in my view, I think the risks are more equally balanced upside and downside. And I think the thing to take away, I mean, it's obviously very worrying. We're seeing this situation where vast amounts of money are being spent by these big tech firms. These tech stocks like Nvidia or Amazon have had an incredible run in terms of performance. And on a lot of traditional valuation metrics, they do look expensive, though those are not the bellwether for how you might actually want to value these things. Altogether, that's obviously very worrying, but it doesn't mean there has to be a crash coming around the corner. It's a truism to say that the only time you really know when a crash is coming or has come is after the bubbles burst. I'm going to put this little chart up here now. And this shows the NASDAQ index. So this is the main index of technology stocks in the US. And why I think this is interesting is this is a template that you see a lot of people referring to today. So this is the NASDAQ index, US tech stocks, through the dot-com boom of the 1990s. It's not a perfect template for what's happening today, but it's not a bad analogy. You had a period where a revolutionary new technology came along, the internet. You think about how ubiquitous it is today. In the 90s, it was burgeoning. And again, you had vast amount of capital being spent, particularly by the telco stocks, pushing this kind of revolution out. And you also had a period where, for a very long period of time, people were calling a bubble, all through the late 90s, all the way to the end of 1999. And they were obviously ultimately right. But along that journey, the NASDAQ doubled, then it doubled again, then it more than doubled one last time just to rub it in. And I think the thing to note is there was a very volatile ride. You had 7 drawdowns and more than 10%. But if you were ever able to get in and out of this and call the timing of it right, I would assert it was complete luck. There was no skill in it. I think we always have to remain very humble when we're trying to navigate markets like this. For what it's worth, and I guess the message we've been going out to investors with, it's obviously a very tough time to be an investor. There's a lot of FOMO. Everyone wants to own some Nvidia. Everyone wants to not miss out on the excitement. And when we're trying to juggle between the FOMO on one side and, shall we say, the faux woe, the fear of getting wiped out on the other, the 83% drawdown, there's perhaps 3 principles that I guess are helpful and that we certainly hang on to. The first is that, given the amount of hype, given the amount of money that's being spent, this is just my view on life, but I think it would be normal and reasonable to assert that there will be an over-exuberance phase. And I personally don't think we're there yet. We haven't really had the big blow up yet where everyone in the world is chasing anything that's got anything to do with AI. I think we'll have an over-exuberance phase. There probably will be a shakeout after that. I don't think you can spend $3 trillion in 3 years and expect everyone to make a return on that money. But the more important counter to that, and something that I've always taken to heart over my time of investing, is that we really shouldn't be in the game of trying to call time when the markets turn. We have to be humble and remember that no one can correctly time the market. Hopefully, you all have a plan that's a much longer time horizon than what the next 1 or 2 years in the markets is going to look like, and you're managing your risks and you have a destination in mind. The old adage I always say is old for a reason, and that is, it's about time in the market, not trying to time the market. And then the last insight I'd throw, which is again a little bit counter to what I was just saying, in the sense that it's probably makes some sense to be relatively relaxed about what's going on in markets as long as you've got a portfolio that's suitable for yourself and all weathers. This last point I want to make, and this is one that's going to tie in with the theme that I was about to talk to, there's been a massive change in the structure of financial markets over the last 20 years. Two big drivers, we'll talk about them in a minute, but one of them has been the incredible growth of passive investing. So people investing directly into indexes using exchange traded funds. And they've been a wonderful innovation in finance, but like anything, it just gets sold and sold until there's a problem. And I can see a problem building. And I guess what I'd say here is that the market has become incredibly distorted. So what's left of public share markets has become incredibly overshadowed by the success of these tech stocks. When you have a situation where 40% of the S&P 500 is made up of just a handful of high-risk, high-reward stocks, I think it's honest and fair and true to say that an investment in the S&P 500 today is just a much riskier proposition than it was 5 years ago. You're probably getting paid for the risk. It's probably fairer to say it's a higher risk, higher reward proposition, but it is a far less diversified, far higher risk proposition than it was 5 years ago. And I think the final message I'm trying to leave our investors with is really to say that these tech stocks are incredible and they're exciting, but you shouldn't accept as default the very high weighting index providers gives to them now. I don't think it's appropriate for people in their 60s and 70s to have 40% of their portfolio invested into high risk, high growth tech stocks. That might be great if you're 21 and you've got a lifetime ahead of you to compound and save, where you should be taking high risks. But if you're 61, if you're 71, I don't think that kind of weighting is really appropriate for every investor today.